Welcome, Perennial Pride listeners. Thanks for joining me as always. Hopefully, you're getting some great education from this, and I appreciate you as listeners. And hopefully, we're helping you build the financial freedom you're just seeking in life so you can make the impact and contribute in the areas that are most meaningful to you. So, today I came on thinking about a couple things. One, obviously, there's a lot of things going on in the economy at the time of this recording, potential recession, seeing some increased volatility, a lot of things going on. And unfortunately, there's a lot of things we can't control around it. We got a potential rate cut coming. And so we'll see how that unfolds for asset prices and kind of the economy. But, when times are a little scary and as I read more about this and experience it personally, that there are likely going to be opportunities that present themselves as potentially chaos happens in some situations. And, what I've clung on to over my time to not get me all stressed out is that, luck sometimes presents itself in these scenarios. And, there's a saying that goes, luck is what happens when preparation meets opportunity. So yes, we can get stressed over what's happening, but to take control over our situations in life and give us the highest chance of succeeding is being prepared for it. And so we can seize those opportunities because a lot of times when those opportunities are there, they can close very quickly as people and others see it and take advantage of it. And unfortunately, when I see many folks and based on the typical financial advice, that yes, they may have some emergency money, but a lot of the money is locked up in two main areas. One being in their qualified plans, with their IRAs, 401ks, and it's deferred till someday, when they can access it, or in their home equity. And we've seen that more recently, a lot of cases where home prices have gone up dramatically, inventory low, and there's a lot of money stuck in there. And so if opportunities do come, it's hard to gain that cash. And then we still have a lot of taxes that are going out in people's lives. So there's a lot of money flowing away from folks. And so if opportunities do occur, then having access to cash is going to be key. And obviously today is a little unique and you can store some cash and make some decent returns on it. That likely will probably reverse course as the Fed starts easing rates and such. But for now, it's not bad. But even for many people, they have a limited amount there and they want to keep it as emergency funds. But what if you had an opportunity fund and money that you can access? And so that's why we certainly promote that, to have opportunity money available. But if you don't have that today and that's something you want to build, that's a separate topic. But there's potentially money that you can leverage in other areas of your life. And so today I want to cover some basic options for that and some with the pros and cons of it, because there's what I've come to realize in my life, looking at different types of strategies and financial tools, there's not one magic bullet for it all, and they all kind of come with their good sides and the bad sides. So you just got to recognize that and be disciplined on that to be able to use them properly, because I think they all have a potential for benefit if you understand them and understand how to use them. So let's go with the basics. And again, we're talking about assets that are available to us. And so we're going to focus on how to leverage them without liquidating them. Obviously, you can sell them, sell your home, so get out of these assets. But we want them to continue to grow and build. And some of them are illiquid anyway. So how can we tap into them? So unfortunately, this for some that maybe don't like it, it's about leveraging other people's money and debt. And debt can be a scary word for a lot of people. Some people it strikes fear and pain for others. But for those who are knowledgeable about it, we can strategically use debt as leverage to take advantage of opportunities or make more on our dollars as our other assets remain sort of still growing and untapped. So some of the basics, right? Let's go, what we're used to in this economy now. We're super leveraged to the tilt in all different areas. And now we're starting to see some of the mass citizens in America getting tapped out. So they're tapping into credit cards, right? Credit cards can be a beneficial short-term source of capital. for folks, but obviously the interest rates on those can be significantly high. So if you have some short-term needs, there could be cases where you can use those personal credit cards that are not backed by anything. So they're going to charge you pretty high rates. And given today's environment, those rates could be well over the 12, 20+%. So you wouldn't want to allow those dollars to compound with interest for too long, right? So this is really for maybe for short-term sort of opportunities you can get in and out. Now, obviously, I use personal credit cards primarily to get like a month free of financing, and then I pay it off, right? That is probably the more disciplined approach to it. Doesn't incur any interest costs, and someone give back reward points and travel points, whatever, and you kind of could get a little bonus from leveraging someone else's money. But just stay disciplined to pay it off. But if you're using it as a potential to leverage to use for investments, you got to make sure that there's a short time horizon involved with it to be able to pay that back, because that interest can get painful very quickly. So it's something just to be mindful of and use it strategically. And, yes, there are potentially a lot of dollars out there that you could leverage, but, again, the cost of that can be prohibitive and really start causing havoc, especially if you don't pay it back and you start defaulting on these things, could really hit your credit score, and that becomes a different issue that we don't want to deal with. And so definitely have to use it with caution, but it is not my go-to place to source some dollars, but it is there for sure for short-term needs. Now, the second spot for those who have assets and have a personal residence, as we've seen more recently in the economy, this asset has grown for a lot of people in terms of value. And so there's potentially a lot of trapped equity stuck in people's home. And, when you really think about it, the equity in your home actually has a zero rate of return to it. There's no really return happening. Your house either goes up in value or down in value, regardless of how much equity you have in it. So the equity's kind of just stuck there, just hanging out, waiting. And for many people, that maybe you have a couple options. One being a home equity line of credit, which, I highly encourage folks to consider that. Now, some people are worried of taking on debt. Well, it's just a line of credit. So, until you use that asset, you won't incur any interest costs to it, but it's sitting there waiting for you. It takes some dollars to maybe keep it open, maybe an annual fee, but it's nominal. It's really nothing, and so it's against your property. Now, the good thing is that you can open that up and you only pay when you use it, but not everyone qualifies for it, right? You have to show, prove income, be able to, prove that you can pay this back, even though you have an asset in your home. So you have to have some income. So God forbid, like you lost your job, you can't go tap that line of credit, or go ask for one because you have no income coming in. So get it before you need it. And this is about being prepared, right? Having that access of line of credit before you need it. And so then you can unleash it and use it when the opportunity presents itself. Now, this day and age with interest rates where they are, tipping in the 7 to 8 range, depending on your situation. So it's not as cheap as it has been, but it's not too bad. And depending on where you're using it to invest, right? If you're investing something, that's 15%, but you're borrowing 7.5%, you basically got 100% return on your money, right? So you're just using an arbitrage in that sense. So you have to understand where you're investing. And for those who are using it maybe for home improvement, right? Maybe you're looking to sell your property soon and you want to improve it. If you use it for home renovations, you can actually deduct those interest costs from your tax return, right? For home improvements only. That's a current only stipulation. And it's flexible, right? These are flexible dollars that you can, pay back. There is going to be an interest charge every month, so you just want to make sure you pay that. But you have some flexibility when to pay back the principal over time. And a lot of them are 10 years roughly in the sense. So, you got to just watch that because they can take these away from you, right? And you maybe want to just take a look at the contracts with the home equity line of credit so you know what you're getting into and when a bank could call that back, that note back. And, there are stories I've heard from others. I haven't experienced this directly, but, if you don't use it, they can take it away, right? Because maybe banks get a little nervous, right? The economy is potentially down and going into a recession, asset values fall. So the banks maybe get a little skittish and want to take that credit away just in case something happens, right? And so that they're not exposed. Now, Some of the downsides is that it's obviously if you start defaulting on this, they can come after your home, right? Hopefully you have some equity. So worst case is you can, sell your home, but that's not always a positive thing unless you're looking to do so. The rates are going to be variable, right? So we've talked about like 7.5, 8%, and that'll go up and down. So they could increase with rates if they go up. Again, there are some fees up front to get this set up, maybe some appraisal fees, and you just have to be disciplined with it, right? It is a line of credit and debt. So again, it's for folks who are staying on top of it and at least monitoring the payments and making some payments to it to ensure that it doesn't get out of hand and interest starts compounding on itself, right? We want to be on the other side of it. We want to compound our assets and have them not stop at any sense. And we don't want that with our interest. We don't want our interest to continue to compound. So something to consider. A third area, which a lot of folks who maybe are in the stock market have brokerage accounts. Something that some people use are margin accounts. So you can leverage your big stock portfolio and use that and get a loan from the brokerage or bank, and so you can use that. So no, usually they allow you to take about 50% of it, roughly, so you can get quick access to money. So it's good in that sense, and it's backed up by your stock portfolio. And the rates are typically pretty reasonable with these because they have your stock as backing it up as collateral. So, obviously, and they only give you up to maybe say 50% or lower. And I wouldn't, just like any line of credit, I wouldn't use all of it anyway, regardless if it's your home or your stock portfolio. And because you're not really selling an asset, and this is, you hear these sorts of things where you borrow against assets, don't sell the assets because then it becomes a taxable event. Because you're borrowing against this asset in your stock portfolio, there's no tax implication to using it. And so you can keep your asset in whatever stocks, keep growing, and until someday maybe you sell it or donate it or whatever. Now, there are some cons to it for sure. One, you can't use it. You can't get access to all your asset, right? Like I said, typically they're going to shield maybe 50% ish to protect themselves. And if the asset drops in value significantly, there could be this concept of a margin call where you have to put up some more money, deposit some more funds in there to ensure that you've stayed in that 50% limit. If your asset falls, so you may have to contribute that or pay back stuff. So there's something a risk, and again, this is why we don't want to take out all of it and risk it all, but you still have some cushion in there. And unfortunately, this asset is volatile, so it could go up and down. So we just have to be careful with that. And the interest is not deductible. Like we were talking about the home equity line of credit, you could deduct that if you're using it for home improvements, but here it's not really deductible. And so you can't really apply that against anything else. So it is an interest cost. So the last one I want to cover is a different asset that we use too. This is tied to the infinite banking concept and life insurance. So it's just a different institution. So here, the first few are from banks and brokerage companies and such. But this one's from a life insurance company. So this is where you can store wealth in life insurance and tax deferred vehicle, and most of the contracts we use, certainly with the mutual insurance company, there's a guaranteed loan provision built into the contracts. So you can access your funds fairly quickly within a few days, and there's no, credit checks, nothing associated with it because you're dealing with a private institution and you're borrowing from the life insurance company. It's typically pretty quick and easy, and they can give you up to, say, 95%-ish, 90 to 95% of your asset value. So get a good chunk of it because they're fairly protected because obviously it's against your life and that's a guaranteed event to occur over your lifetime. So it's just something that's a pretty safe environment and they're completely protected. And they're typically favorable interest rates right now. You're in the 5-6% range, something in that neighborhood, typically pretty good. And you could have options depending on the type of company, whether it's fixed or variable. So you have those different options depending on the company you're working with, and sometimes they give you options up front. Really good part about this too is its flexibility because there's no really payment schedule. Again, this gets back to being disciplined and with your money and being an honest banker. Is there's no payment schedule per se. And so this is where, if you're taking a loan to use it, and I've used it for investments and real estate and such, that you create your own sort of payment schedule and pay that back at minimum the interest. And so because that interest will compound if you don't pay it. So you have to be responsible with it, but you have flexibility because there's nobody coming knocking or going to grab your asset if you don't pay it. And obviously, just like a lot of the loans we take, loans are never really taxable. So this is access to tax-free money. And obviously inside the policy continues to work whole, right? The cash, right? So that's still growing tax deferred. And obviously still, as you're borrowing, it just, you still have your policy in force. So if anything happens, you pass, it will pay the debt, and then, your beneficiaries get the balance tax free, right? So good in that sense. The cons is that, you are lowering your death benefit. So as you're borrowing against it, you're basically leveraging your cash, right? And borrowing from the life insurance company. And so, any debt that is outstanding when you die will lower your death benefit, and then the balance goes. And the good thing about life insurance, because it's basically leverage. You're paying $1 and you're getting a larger death benefit. So there's always typically some leverage built into it. Then so they'll have enough room there to pay the debt and then give some to your heirs or charities. And if you're not careful with it, right, again, and there are some protections built into these policies if you overextend yourself with the loan. If you aren't disciplined to pay it back, there are things that can be adjusted with it, but there is still potential for lapse. And if you've taken so much money out of these accounts and policies through a loan, and if you default on it, then the gains can be taxable. So you have to be really careful again, just like any line of credit or debt, like be careful to overextend yourself. And I usually keep, 20 to 30% of my assets in there just to protect and give me some sort of cushion. And, there could be a case where, so on the con side of this, I kind of shared a couple of them, but there are some certain types of companies where the cash value growth could be impacted by the amount you borrow. There could be a lower dividend applied to the loan dollars, depending on the type of company. So you guys be leery of that and aware of that potential. And again, we talked about, policy lapsing and potential tax consequences to it if you have your policy lapse. So again, this is where you want to make sure that, you're a good steward of your wealth and your debt, and you're making some payments back or have a plan to pay it back down the road. And lastly, I think it's important to point out that, the 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 flexibility with this type of loan is a good thing, but you can't, you have to kind of watch it annually, because you don't want that interest to constantly compound over time and build. Just like we want our assets to grow. We don't want our interest in these debt portions to grow without being watched or managed, because it could really compound over time in a negative way. So hopefully, I just want to do this short little video on this and give you some options. There are untapped wealth within your homes, against your stock portfolios, your home, your cash value life insurance. There are other vehicles, but these are some of the main ones I see with people, and they have access to. And just like anything else, is being prepared and knowledgeable about them and having different options. Because what I have found over my course of time, investing and managing money, that opportunities will seek you out if you have cash, and people who know you have cash will come to you, and opportunities that many people will miss and never see in their lifetime, because if you have cash, people know it, right? And you put it out there. And so here's a time to get prepared with it. And as things change and economy changes, there will be people that unfortunately are going to be distressed and have to liquidate, and you might be able to get assets cheaply, but those who have the cash are ready to go do it. So I hope this was helpful and gives you some food for thought. And certainly, if you want any help to discuss this, certainly reach out. I'm more than happy to help. And we'll see you on the next episode of the Perennial Pride podcast.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it, and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.